Hi friends, a lot of us may be investing in simple index funds like Nifty 50 or Nifty 500, but many of us are not even aware of index funds that have given very good returns and in fact have beaten Nifty 50 on a longer term basis. So in this video, I want to speak about 3 such index funds that have given better returns than Nifty 50 over a longer period of time. But before I start this video, let me also set some context. Have a look at my screen and you will see the top 5 sectors that contribute almost more than 75% into the Nifty 50. So here, for example, as of 2024, you see financial services, IT, oil and gas, consumer, auto and logistics, these 5 sectors. If we total their weightage in Nifty 50, that is almost 75%. But more interestingly, if you just total the financial services and information technology, that itself is almost 47% contribution in Nifty 50. So the natural questions are, Rahul, A, is it even possible to invest in such index funds? And B, what sort of past returns that these indexes have performed? So in this video, I'm going to break it down for you in a very simple and easy to understand language with a lot of data backed analysis. People who do not know me, my name is Rahul Jain. I'm a full-time investor and a content creator. With that, let's get this video cracking. So the first index that I want to cover is Nifty Bank TRI. Have a look at my screen and you will see that there is a good performance by Nifty Bank over a longer period of time. And if we compare the performance with Nifty 50 index, very interesting points to note. Point number 1 is that over a 10-year basis, we clearly see that Nifty Bank, which is in the purple color, has given almost 18.9% yearly returns, while Nifty 50 had managed around 14.2%. So almost 5% uplift is what we can see over a 10 years period, and 98% times Nifty Bank has performed better than Nifty 50 over a 10-year period. Now, if you look at the 7-year rolling returns basis, 5-year rolling returns basis, 3-year rolling return basis, in all these time periods, Nifty Bank has comfortably beaten Nifty 50 in the past. This data is as of March 2024 and I have taken this data from Axis Mutual Fund Research. Now, of course, past return does not guarantee future return, but the past trend does tell us a lot about what is going on in the index fund world. Second interesting data point that you need to understand is, if you ever want to invest in Nifty Bank index fund, how is your money getting split across the banking sector? So for this, have a look at this data. You will see that if you invest 100 rupees, out of that 100 rupees, around 29 rupees goes to HDFC Bank, followed by 23 rupees to ICICI Bank, and so on and so forth. This is an interesting point for you to assess your risk, because of course, if out of 100 rupees, 29 is going into HDFC Bank, for example, right now, as per the latest data, then it does bring a question that, are you getting concentrated in terms of your risk appetite or not? If you look at the market cap, by market cap, around 92% of Nifty Bank's contribution is by the large cap stocks and around 7.11% is by mid cap stocks. And this is an interesting difference between Bank Nifty and Nifty 50, because in Nifty 50, all the stocks that are there are all large cap stocks, while in case of Nifty Bank, around 7.11% is around mid cap. Now, from a private bank and PSU perspective, of course, there is a diversification here. Almost 85% allocation is to the private bank and around 15% is to the PSU bank. Again, the data is as of March 2024. Now you may have a natural question, Rahul, should we invest in Nifty Bank or not? It is entirely up to you. It is not a recommendation. Also, before you do that, you have a look at the valuation. So for example, have a look at my screen and you will see that Bank Nifty as on 8th of November is showing a PE ratio of 14.2. And if you look at the last 5 years historical PE average, you will very quickly note that the 5-year average is around 21.34. So right now, Bank Nifty is trading well below the 5-year PE ratio. And if you see this pink chart, it also shows us how the valuation have changed in the last 1 year. Right now, the valuation has come to the bottom here in terms of the PE ratio. It is trading at 14, almost at the bottom in the last 1 year. Now comes the last question on Bank Nifty, that Rahul, if you want to ever invest in Bank Nifty, which are the index funds and how to go about filtering them, let me quickly show you a very interesting tool, free tool that you can use to explore and compare any index funds whenever you want it. So I'm heading to Ticker Tape, a free website that you can use. Simply go and click on screener here and then select mutual funds and say start screening. What you're going to see is all the mutual funds, 1500 mutual funds come here. Now the first thing we need to do is, in the category, just type the index funds here. Now what the platform will do is it will filter out all the index funds. The second thing is, we are not interested in all the index funds. We are only looking for Nifty Bank index funds. So what we are going to do is add a filter and type here benchmark. So when we type benchmark, we are going to add that as a filter. And the next thing we are going to do is, in the benchmark, go and in the search button here, type Nifty Bank. Nifty Bank TRI, and you click on Nifty Bank TRI. Now what this website has done is it has filtered out all the index funds and have given you those indexes that are benchmarking themselves for Nifty Bank TRI. Now you can do a lot of analysis on these 7 index funds right now that this website is showing. So for example, let's filter them out by expense ratio. So let's arrange them from lowest to highest. Axis Nifty Bank is the cheapest right now, showing an expense ratio of 0.09. You can also add other parameters. So for example, come here, add filter, and you might want to check the tracking error, which is very important in case of index mutual funds. So add tracking error here, and you can arrange it in the from the lowest to highest. Lowest the tracking error, better it is, right? You can also look at, for example, rolling returns. So if you go to rolling returns, the only thing with rolling returns is that you will have to subscribe as a pro member for this. I am a pro member, that's why I can see. For free website, you might not be able to see it. So let me quickly go and select that. But here what you note is that out of these 7, only one index fund is showing us the data for 3 years average rolling return, because remaining 6 might not have completed 3 years. So what we could do is we look at the absolute returns. So if you go and absolute returns, let's say go for 3 months and click on that. So in the last 3 months, and that's sorted by highest to lowest. If you look at the last 3 months absolute return, for example, Axis again has given the better returns, but you see the returns are very similar, because ultimately they're all tracking an index, and therefore the returns may not vary too much. But this is a method that you can go and filter out any index funds that you want ever. And if you like that, hit the like button. Let me know in the comments a simple thank you. It motivates me to create more content for you at zero cost. With that, let's move to index number 2. Now, before I move to index number 2, if you want to learn on a daily basis and practically from the stock market, mutual funds, ETFs perspective, you can consider joining my YouTube member community. I post almost on a daily basis, bringing you practical insights from the stock market, mutual funds, ETFs, etc. You are going to become a better investor over a longer period of time. The feedback on this community has been excellent. Therefore, go to my channel and press on join button. Also, you can find the link in the description or in the pinned comments. With that, let's move to index number 2, and I'm going to cover Nifty IT, because IT sector contributes almost 13% as of 2024 in terms of the overall Nifty 50 contribution. So let's have a look at how it has performed over 10 years, 7 years, 5 years period. So if you look at the rolling returns here, this data is as of June 2024. I've taken it from Nippon India Mutual Fund. Over a 10 years period, Nifty IT has clearly beaten Nifty 50, 14.9% yearly returns versus 14.2%. But over a 5 years and 3 years period, Nifty 50 has slightly inched, almost about 0.2%, right? And if you look at the last 1 year, Nifty IT has performed slightly better. However, interestingly, if you look at the SIP return performance over a rolling return basis, then you will note that average returns in the last 1 year is 19%. 3 years 17%, 5 years 18%, and 10 years 16%. So these returns are better returns than the 14.9% we saw on a 10 years basis. So SIPs seem to have performed better when it comes to Nifty IT index. Now if you look at how Nifty IT index has been built by, have a look at my screen, you will see that Infosys, TCS, HCL, they contribute the highest percentage. They have the highest weightage in Nifty IT index, almost 38% by Infosys. TCS is almost 25%, HCL is 11%. But people who do not know how to pick individual IT stocks, but they still have high conviction in the IT as a sector overall, because it covers a lot of good IT companies. For example, Tech Mahindra is there, Wipro is there. So essentially you're getting a basket of IT stocks in Nifty IT index. Now if you look at the current valuation of Nifty IT, you will see the PE ratio right now at the time of recording this video on 8th of November is around 33. If I look at the historical averages from a 5-year perspective has been around 28.18. So right now it is slightly overvalued from the historical purposes. And if you want to invest in Nifty IT index, again go back to the same screen and simply here reset the benchmark. And what you can do in the benchmark now is add, rather than Nifty Bank, you just add a Nifty IT, and it is going to bring you index funds that are Nifty IT related. Again, go ahead and compare them on the basis of expense ratio, tracking error, past returns, and many other factors that you might want to use. None of these are recommendations from me, so please do not take them as recommendations. With that, let's move to index number 3 now. Third index that I want to speak about is a factor index. It's not a sectoral index, and people who do not understand factor investing, please understand that if you want to invest in a particular index that is trying to generate returns on the basis of a specific factor. So for example, value is a factor. You are investing in an index that only has stocks that are potentially at low value right now, or maybe quality, or maybe momentum. These are all called factors. And if you are a factor investor, and if you believe in factor investing, I want to today introduce you to a value index index, Nifty 500 Value 50 Index. So what is value? Very quickly. So if you want to only buy stuff that is at a cheaper price, discounted price. For example, if you're buying a mobile phone online and if you want to wait until the prices drop, you're potentially into that value buying bucket, and this is where the concept of value investing comes even in the stock market. So Nifty 500 Value 50 Index is an index where you look at the 500 stocks listed on the NSE and you only take 50 stocks in the index, which is by the value. So where the valuation is really at a very low level, you pick those stocks and you invest in an index fund that is tracking Nifty 500 Value 50 Index. Here the difference is that you are not sticking to one particular sector. So for example, Nifty 500 Value 50 Index has around 26% of exposure to financial services, 21% to metal, chemicals, construction materials, power 10%, oil and gas 23%. So it is a much more diversified index. It is not a sectoral index. It is a much more diversified index. Now if I look at the rolling return data, this data is as of June 2024. Very clearly you see on an average 3-year rolling return basis, Nifty 500 Value 50 Index has given around 15.15% annual returns, which is much better than Nifty 50 and Nifty 500. On a 5-year basis as well, it has beaten comfortably 12.87% versus 12.20 for Nifty 500 and 12.02 from Nifty 50. But please understand that you do not invest in index funds only for short-term trading, for 6 months, 3 months. You really need to have a long-term view because the markets go in cycles, and value investing, more importantly, works best when we are in a bull run or when we are in a recovery phase. In the bear runs, it may not perform good. So please make sure that you're not a short-term investor. Only if you're looking for 5 years, 8 years, 10 years sort of a horizon. And if you believe in India's story overall, then yes, value indexing makes a lot of sense. Now, in terms of the valuation right now, if you look at the Nifty 500 Value 50 Index, PE ratio right now is 12.2. And if I compare this with 5 years average history here, you will see the 5-year average PE is at 8.82. So it is on the higher side right now because we have been in the bull run in the last few months. Therefore, the PE ratio right now is looking on the higher side. Now, I could only find 3 index funds that are tracking Nifty 500 Value 50 Index because this concept is fairly new concept in the market and there are not many AMCs that have launched the index funds. But of course, as the time goes, many AMCs may join. But right now, these are the only 3 index funds that I could find. Of course, from a data perspective, there is very little data available on these 3. I could only compare them on the basis of tracking error. Expense ratio is also not available on this particular tool. So what I would recommend is that please go to the individual website of these AMCs. Try to find out the expense ratio, try to find out the tracking error data for confirmation purposes, and also look at the past returns that they might have generated. So in this video, I've tried to cover 3 index funds that have given better returns than Nifty 50 over a longer period of time. Let me know in the comments which index fund you found the most interesting. Also, let me know in the comments any other topics you would like me to create videos on. I'll be happy to consider your request. With that, I hope you enjoyed this video. I'll see you in my next video. Until then, keep rocking.